If you are using technical analysis by itself, you are not going to make it as a trader. Now, that is one wild statement for me to make on a video where supposedly I'm going to be teaching you technical analysis. Hear me out here for a second. I've been trading for a minute, longer than a minute, since 2010. And I've read a lot of books. I've actually read almost over 80 books on the subject. This is 5% of that. These are really good books, by the way. If you want to take a screenshot of this, feel more than welcome. All of them come to the conclusion that technical analysis, this is important, is a way for us to try to rationalize the irrationality of price action that exists in the market. If you didn't know this, human emotion is erratic and it's nonsensical. That is what is being conveyed on the chart. It's not always about you buying at 30 RSI and then picking up from there. If it were that easy, then everyone would be a successful trader. This video and what it is that I want to make sure that you guys understand is that I do not take technical analysis as an absolution. I know how to read a chart. I know how to read a Harami. I know how to read a shooting star, a black cloud cover. I know all that stuff. I know the terminology. But think about this a little bit differently. Think about how many people use a trading system. It's not about how or which trading system is best. That's not what trading is about. Trading is about you identifying where other people see a buy and a sell signal and you exploiting that. It took me years to realize this. But if you can exploit what it is other people designate as a buy or a sell signal, then you are now trading with an edge. That is the whole purpose of you becoming a successful trader, hopefully giving up your 9 to 5 and then doing this full time. Is that easy to do? No, it is the hardest thing in the world to do, especially when you get something wrong. Remember pillar number 2, right? You got to become a master and validator. Those pillars are very important. And you're going to see how we build everything together in order for us to build a system. It doesn't matter what indicator you're using. Honestly, I couldn't care less what indicator or what system you choose. Just make sure you understand the statistics behind the system. Understand if we're identifying an inverse head and shoulders, does it have a good probability of working out on the 5-hour time frame, 4-hour time frame, daily time frame, whatever. You got to understand the statistics of what it is that you're using and what it is that you're identifying. At that point in time, you start to shift the spectrum from being a gambler into being a very methodical, very dangerous, and very focused trader. That is the whole point. Cool? That was my introduction. Hopefully I didn't scare you guys off. So we're going to start off with some of the basics. A lot of the basic stuff you guys are going to understand, you're going to catch really quickly. But realize that we're building on top in order for us to identify what we would consider a high probabilistic trade. Is it always going to be correct? Of course not. Obviously, that's not the case. But we want to make sure that if we are making a trade and putting on risk, that we understand if it goes wrong, what we're going to do about it. That, in essence, is trading. Let's begin. This is where it all starts. IWM off the weekly time frame. This is going to start off very simple, but we will build on the complexity as we start moving forward. I don't want to insult anyone's intelligence, but this is a pretty bare chart. There's no indicators on here. I know that most of you are going to identify buy and sell signals. That's not the point of this segment. The point of this segment is for you just to think rationally about the movements that you see in the market, just looking at PA by itself. PA meaning price action. When we're looking at any chart, always I'm looking for 3 things. Supply and demand zones. Zones are very important because you setting a level here at 163.75 and thinking that you're going to hit that level and then perfectly bounced off of it, only you can see that line. All the other 600 million traders do not see that. And how do I know? Because we don't want to tell the past. We want to tell the future. I don't care that 163.75 was a demand level. If we're not trading back down into that level, I honestly don't care. I care about what's going to happen here for the next couple of minutes, next couple of days, next couple of weeks and months. So all of this is something called an anchoring bias. That anchoring bias is because we see a couple touches in that particular area, all of us are going to have the perception that, all right, we're going to hold that area. There's some statistics behind this, and this is where I want to start introducing more of the mathematical mind as opposed to the bias that we inherently have for long or short in the market. If we're coming back down into this area, all of us, I think, can collectively agree that's a support area, right? It's a support or it's a demand area. We're going to set a particular zone, right? And that zone, depending on what your trading system is, I like to keep it between 2 to 4 points. If it's something that's trading at thousands of dollars, then I generally keep it 10, 15 points. That's not really the point that I want to come across. It's all about how we're going to react into that level if we're going to trade into that zone once again. I will tell you for this video, because it is significant, when we came back down to 95, I actually took a long trade on IWM at 102. Okay. Why did I do it at 102? If you buy Apple at 135 and I tell you, let's put $500,000 of our money collectively, 250K you, 250K me, and we're going to buy into the stock. 135 seems like a good number. Why would you do something like that? You have no context built around what price action is doing, what the company is doing. You didn't tell me anything about the financial statement, and we're definitely not talking about overextended RSI. We're not talking about those things. So here, me telling you that I took it long at 102, 101, how do you possibly know that I wanted to make a trading decision here? It's because you need to go back in time and then build that context. Remember what I said. Everything that you do in trading, especially when you're talking about supply and demand areas, is based off something called an anchoring bias. We don't know. We have no clue where it is a stock is going to be trading. All we know is how to read financial statements and then what technical analysis teaches us. If there's a hammer here, if there is an inverted head and shoulders pattern here, if there is a triple bottom or a triple top there, we can interpret that information and use it to our advantage. Very different than you saying, hey, we're coming into 102 and I'm going to be putting $500,000 behind this just because. There's no thought process. There's no strategy there. So my strategy coming back here is I set a zone. I knew the context back to 2016. I knew that there was context on that touch. We touched into this area, and if we started breaking below, think about this as an institutional trader would. You probably have stop losses set at maybe about 90. So here, maybe you're going to incur a 5-10% loss if you bought into shares. Options, more than likely, you're not holding options for 5 years. So if we start breaking below that threshold of 95, then we don't know how low we can go. We have no idea. Anyone that tells you different, saying, I know exactly where the bottom is ridiculous. It really is ridiculous. You have no idea where it's going to go. So some of you are saying, hey, the RSI and the MACD are going to tell me if I'm oversold or overbought. Fine. But that one indicator or that one metric that you're using is not enough. You need to have confluence. Confluence is just a fancy word of saying, hey, 2, 3, maybe 4 levels of confirmation. Anything over that is overboard. But at least 3 is what we recommend. So let's discuss that. Supply and demand would be, okay, I'm coming into this particular level and I just want to see how we're going to react into that level. This is another very, very good example. We'll talk about multitudes of different examples so you guys can understand. Do not think that IWM, going back in time, I'm saying, hey, I caught this trade and look how good it is that I made or how much money I made. There's no purpose to that. The purpose is for you to identify this trading pattern and then apply it to any other situation that you will find yourself in. Remember with pillar number 2, this is huge, right? We have 3 pillars in trading. Pillar number 2 is if I'm wrong, it's invalidated, I'll take my 5-10% stop loss. And that ties into pillar number 3 perfectly, risk reward. If I have good risk reward on the trade, I can take losses all day long, right? As long as they're relatively small and I have control in what it is I'm doing, then I have to just tweak my entries. I have to read my buy and my sell signals better. So everything is intertwined. Coming back down into here, how do I know? How do I know that I was going to bounce off 164? You have no idea. You have absolutely no clue. How did you know that the second time we came into that area, we were going to bounce off it again? You have no clue. The statistics say that if you come into an area 2 to 3 times, then that is an area of interest. Because if you cannot defend that area, if buyers are not taking hold, then that means that there might be a projection lower. What I'm going to say here now has nothing to do with supply and demand, but it has everything to do with trading etiquette. Remember that video when we were talking about just being subtractive, but this also has to do with trading etiquette. If you are ever going to take a position, you don't want to just have one demand area. That would be a mistake for you to make. Let's jump on here for the 30-minute time frame, and let's see exactly how we can apply this one principle. If we're coming into whatever demand level that we designate, let's just say right here, we're going to create a zone. I have 1, 2 touches here. most of you are going to say, okay, I want to wait for an additional confirmation. I don't like the two-touch principle, Sage. I want 3. Cool, no problem. You're going to come back down here, and guess what? We made a higher low right there. But that higher low was obliterated because we went for a liquidity grab back down here. Most of you are going to say, hey, if I took this entry, I took a bad trade, and I disagree with you. I disagree that if you came into this area, you put in the higher low, you are trading off of data. And you're trading off of a trigger where if I come, hit that level 3 times, made a higher low, and then all of a sudden it seems like it's starting to build some price action back into a resistance area at 225. Most of you are going to say that is a bad trade because the next day it got back down to 213, 214, whatever the case was. I actually remember this event. I don't want to bring it up because it's not significant. But you break below, you take it at, let's say 220, and then you break all the way back down to 213. Did you take a bad trade? It is only going to be a bad trade. Only going to be a bad trade if you did not anticipate or you set in your mind where this is going to be an absolute banger of a trade. That is the mistake. And of course, risk reward, make sure that that is always at the forefront. And you better have that stop loss. If you triggered the stop loss and you took a 10% loss off of a gap down, it is what it is. It's part of the trading gamut. It's just part of trading. You're not always going to get this right. But Sage, you said statistically 3 touches is pretty good. Yeah, it is pretty good. But it doesn't mean it's always going to work. This was news-based. Remember what I said? Technical analysis is not 100% tried and true accurate. You have to consider geopolitics. You have to consider just what's going on economically. You have to consider that now any stupid tweet that comes out can potentially move the market. And that's exactly what we're dealing with. So how do you put the probability back in your favor? You take the proper setups. Now, if I were stopped out on this trade, I am going to tell you that I would probably look for a re-entry on this trade. Remember what I said. I don't only have the one demand level. I'm going to go back here to the 1 hour. So I have the demand level here, but I'm probably going to set another demand level probably close to there. Why? Because I have 2 touches in that zone. So do you see? This lines up quite well. This is not me doing analysis on price action that's happened in the past and then lining up my narrative to fit the fact that I'm trying to teach this subject. It is very different. It actually is 2 touch points that I would look at and designate as potential areas of entry. You went for a liquidity grab here. This is more of actually it's a little bit more of an advanced concept, but it's a trading concept that I use very often. You have 2 touches, you broke the demand level, but you better have another demand level on your chart. I generally recommend 2, but I'll be honest, I do 4. So the next demand area that I would have here on IWM would be all the way back down to 207. Most new traders are going to say, Sage, it's not going to trade down to 207. I don't know if it is. I have no idea. Do you know? I don't know. If it does trade back down to 207, then I'm going to use my risk reward calculator. I'm going to do something like that, and I'm going to set my stop loss about there. The lower we go on a good quality ETF or good quality stock, generally that's where it is I'm making those big decisions. So let's circle back here to IWM on the weekly time frame. Why did I make that big decision here? I can be here all day talking about where it is I made big decisions and how it is I grew my trading account over the last 10, 15 years. It's all about making big trading decisions on those good risk reward trades. I generally take shares, but very often I'll do a put credit spread, or I'll just do something like I'll do calls. I'll do calls and I'll do them just a couple weeks, couple months out. This is a swing trading concept, but you need to understand this concept in order for you to get better with swing trading, with selling, with option buying, with just buying shares, or even trading futures. All of the foundational concepts, they don't change. They really, really don't change. So why did I make a big decision here? Well, I knew if I made a big decision there, I would set my stop loss accordingly. I put a lot of money into this trade, and then I wrote it up. I literally wrote it up to almost 100, and I took it off at 147. So I took it off at 147 because the risk reward for me was already great. I thought we were coming into resistance on that candle. I got scared out, but the risk reward was 9-1. This is it. This is trading. This is what you need to apply for every single trading decision you make. If you're going to go off of the 10-minute or the 30-minute, we'll revisit that. What is to say that you breaking below the 3-touch area, the demand area, why can't you re-enter the trade, right? Is it completely invalidated? Well, you started seeing some buying pressure right here. And then remember, we identified off the 1 hour time frame. There's another demand level there. Do we know it's going to be a strong demand level, or are we going to bite the dust second time in a row? That's a possibility. Stop thinking that I took 2 losses or 3 losses in a row. Now I'm a crap trader and I'm never going to do this again. I'm never going to make this work. That is the worst thing that you can do. It is literally the worst thing for you to take or accept normal losses, 5-10% losses 3-4 times in a row, and then think that you're a horrible trader. You would be a horrible trader if you held on to this position and you didn't have some sort of system or game plan. If you do not know how to manage your risk, that's what makes you a bad trader. It does not make you a bad trader for taking a 10-15% loss here, whatever the percentage is, and then getting back into the trade. Notice, we're not even talking about moving averages, TTM. We're not talking about ICT. We're not talking about anything. We're just talking about price action. And we're talking about how to think mentally about what it is you're actually doing. This is supply and demand. Probably very different than how it is you guys learn about supply and demand level with anyone else. When I started applying this principle, then on top of that, I'm adding my indicators. I'm just going to throw a couple of them on here. I'm adding my indicators, and then here, I'm identifying a buy signal. I probably would have taken a buy signal off of 218. I didn't do that here, but I would have taken it off of 218. If anyone knows my trading style, or if you trade with me and been trading with me for a while, I am going to take that 10 times out of 10. All right, I was just in a whole bunch of other things, but I'm going to take that trade. And then I'm going to ride that up to a perceived area of resistance. So let's just look at the risk reward. We haven't even discussed all these other things that are on the chart, but I will take that trade every single time. Would I have caught that move there to the upside? Yes. Yes, I would. And I have numerous examples of this happening pretty consistently, right? I'm usually pretty early to the trade. Now, I'm early to the trade because I'm applying all these principles that we're discussing. So now let's go back to bare bones stuff. Let's go back here to the daily time frame on IWM. And a lot of you are using higher low principles. And I really like the fact that a lot of you are doing that. Higher low principles are going to tell you if there's momentum in the market or not. Some of you are using, as I've stated many times, RSI, MACD, and you're just seeing corridors overall on whatever stock. Now let's go back to QQQ. There's an extremely clear corridor here. This is not, I don't need the brownie points here, but I called long on QQQ all the way back here, right? I've been long on QQQ for a very long time because of that principle that we discussed on IWM, not because I know something that you don't know or something that you can't identify yourself. It's all about just making sure that our lens is nice and clean and we can see things for how they are. Not necessarily that I knew QQQ was going to be trading up to 535. I had no idea, absolutely no clue. I just knew that as we were coming into certain pockets, as I'm applying some of the indicators that we will discuss, I identified these almost every single time. Almost every single time I identified this. And what's even easier for me to identify is DIA. This is by far one of my favorite things to trade because it is quite simple for you to identify some sort of momentum. Let's go back there to IWM and let's talk about those higher low principles. Do we see a really strong trend like we saw in QQQ and DIA? Probably not. This is it on the monthly, right? So there's this huge gap up, huge gap down, but overall that trend is up. You guys are not taking entries off your monthly time frame. At least I hope you're not. What you're doing is you're just building context. You got to know, is Apple at a good price at 135? I don't know. Show me the rest of the chart. Show me the weekly, the daily. Show me some of the financials. Show me some order flow. Show me where the moving averages are. Show me where the order blocks are. Show me where the supply and demand levels are. Then I can build a decision and make critical financial decisions off of that information, right? If you're doing this off the 10-minute or the 5-minute time frame, the principles do not change. What do we have? I'm looking for a couple touches. Remember, I like 2 to 3. Most of you are saying, hey, 3 touches and then I'm good to go. I'm between camp 2 and 3, right? That's where I live. How do I know that this is going to reject here? You have no idea. No idea. That is a common theme with me. You have no idea what the price action is going to do. If you have good risk reward to the downside, you take a downside trade. Good risk reward to the upside, you take the upside trade. No bias introduced whatsoever. Let's say I want to wait for a setup off of the 10-minute. What am I going to do? I'm going to give this the context that I think it deserves. First area of interest that I would designate is probably 222.35. Now remember, it's never concrete level, but always a zone. So let's actually get that concrete level out of there. Let's get rid of that. If I trade back into the zone, I'm going to use my moving averages. I'm going to use some sort of oscillator, and then I'm going to try to identify, hey, is this even an area that's worth my time? If it's worth my time, I'll fire the trade. If it's a day trade, I'll hold on to it, and then I'll move up my stop loss, which is something you guys should be doing. Now, let's say we don't get into that area because that's way too much selling pressure that we need to go through, right? We need a 1.4% sell-off on IWM on a single day. That doesn't really sound that feasible. Well, then you start moving up. Remember what I said about how many demand levels I usually have on whatever time frame? Most of you are doing just one. I like to do up to 4. So let me do 4. I'm going to do there. I'm going to probably do there. I'm probably going to do there. And then more than likely, I'm going to do this right there. Does this line up with order blocks or line up with ICT or line up with any other system that you guys are using? More than likely not. Remember, only I can see these blocks, but I understand supply and demand quite well. So the lower we go, I want you guys to really, really see this in action. The lower we go, I just got to make sure that I'm at least adhering to a 2-to-1 principle. I don't have to take this all the way up to here. Most novice traders are thinking that they're going to put on a trade and then they're going to try to take that up to the 1 hour supply level. That is a mistake. You want to take it to its most recent supply level. That most recent supply level, you can argue that it's at 226.95. You can also make an argument for 227.66. This is the subjective part of trading. What I would recommend is if you want to take it up to 227.65, that's fine. You have a 6-to-1 risk reward. At least keep it at 2-to-1. If you do at least 2-to-1, you're going to be okay in trading. You really are. You really are. You don't need that much. Now, just take notice. If we go even lower, then I can exaggerate this point a little bit more. If I go even lower than that and wait for a potential setup to come back to me into whatever demand level you want to designate, because demand is extremely subjective. If you want to come back down to here, then you have better risk reward, in my opinion. Cool. But Sage, you just said, hey, take it to the most recent resistance area. Well, that's the most recent. I can't account for this because it's not the most recent. So that's the most recent area there. And I can use that. That's the second most recent. And then I can use that, the third most recent. Most of you traders are already pretty clever. You guys are very clever. You're going to say, Sage, I don't need it all the way up to 225 in order for me to make a buck. All I need is I just need it maybe up to there at 224. So if I can catch a riff at 223.35 up to 224, I'm good. You're starting to get it. You truly are starting to get it if that was your thought. So let's remove all this. Doesn't matter if it's the 10-minute time frame. You guys can go as low as the 5-minute. That's okay. I don't like trading off the 5-minute, but the principles, they're not going to change. Notice that I have one support level right here. In my opinion, I'm going to look at this from my experience level, and I'm going to say, all right, I might have an order block at about there. I'm just guessing. If we come back down into this level and then I start noticing off my indicators that I have a decent buy signal, that buy signal will be taken. I had a decent buy signal there. I had a decent buy signal right there. And I also had a pretty decent buy signal right there. I'm not going to explain why I identify a buy signal there for right now because it's not important. We're trying to go a couple steps and we're trying to run before we're even crawling here. But just looking at this chart and being able to identify your system is where you want to be. Just notice, I've done this thousands, tens of thousands of times. It's not that I think that this is going to go up. My opinion does not matter. Your opinion does not matter. What matters is you executing your system and making sure that you stick to pillar number 2 and validating the level. Let's erase all of this and let's go back to the 4-hour time frame. And now let's build a context without the indicators. We have an extremely nice trend here. I am not interested in putting on a long position after this trend has already hit 3, 4, 5 different levels. I don't care about that. To me, this is a waste of time. Where I see value is off the 4-hour time frame. If you're trading off the 4-hour time frame, this is not enough context or information for you to identify, hey, this is a pretty good demand level. You have to build out on the higher time frames. So notice on the 4-hour, does everyone see that? You can very clearly see what the bottom was. The bottom was 163, and obviously if I took this October 27, 2023, I would have killed on this trade. But how do I know that this is the start of the trend? You don't know. It's always the same answer. You don't know. Build the context here. Would I have signaled a long trade or would I have taken a long trade if I knew that these were areas that touched and this was the third or triple bottom? More than likely I would have. If I'm putting on my indicators, which I will not explain right now, you guys will understand why I'm not explaining this right now. I'm looking at that and then I'm identifying the buy signal. I would probably say that my buy signal is close to 173 or 172. I would take that and then I would just apply the calculator. It really, really is just a matter of this. Apply the calculator and I have a 5-to-1. Okay, 5-to-1 risk reward. If I'm putting 5% of my portfolio or whatever it is that you want to risk, 1, 5, 10, probably wouldn't recommend more than 10, but just saying. If you want to risk 100% of your portfolio, fine, whatever. You want to do that? Just make sure that you are adhering to this. If that starts breaking below 166 and you're buying shares, cut it, invalidate it. Do it pretty quick. Cool? That's IWM off the daily time frame. We're going to do one more example, and I'm going to go a little bit quicker. You're going to see how it is I identify just whatever arbitrary stock that comes to mind. We're going to talk about the supply and demand areas, the higher lows, higher highs, and then we're also going to talk about the touch areas. I'm going to try to pick a difficult stock because a lot of us are looking at something and we want to force a trade, and we want to be in a trade just because we want to be in it. And I'm going to explain, and hopefully I can convey to you why it is advantageous without using any indicators at all, just simple price action, why it's advantageous for you to wait on the setup and wait for the market to come to you. We're going to do that here in the next segment of the video. That was a lot of information. If you need to take a break, please feel free. I'm going to pick what I would say is one of the most difficult things for you to do technical analysis on. However, it also is one of the things that people are most interested in trading because you can make a lot of money if you can get the direction correctly. Without building too much anticipation, it's going to be Tesla off of several different time frames. I'm going to share with you where I took Tesla. I took it twice in the last year and a half. And I'm also going to share why I don't like taking it at this particular point here for the beginning of 2025, depending on when you watch this video. And we'll discuss how it is that I'm going to maybe put risk reward back on my side and why it would be worthwhile to wait on the position. Let's dive in. As you can imagine, I'm asked pretty consistently on my opinion on where Tesla is going to go at any given time frame. Now, I look at Tesla, and for me, it's an extremely difficult stock to trade. You might disagree with this. You guys probably have tremendous success with Tesla. In the last year and a half, I traded it twice very successfully, made absolutely banger money on it. But now looking at it on the daily time frame, I'm going to explain how I'm thinking about this so I can have the trade become more on my side as opposed to what is it going to do now in the next couple days, couple weeks. I would prefer to sit this one out. So let's spend a couple minutes, maybe several minutes on going over, maybe applying some of the things that we've already discussed onto the Tesla chart. First and foremost, as a new trader, this is something a little bit beyond the scope of my explanation, but let's say you caught a run on Tesla, this magnificent run that it had before Donald Trump was elected. It had a really good run. It was actually 125%. Right? And a lot of traders actually caught this. We had some traders also in our group that caught a lot of this move, made quite a bit of money. I think that with your experience, sometimes this could be to your detriment because you think that this is realistic in trading, and it's not. Something that moves this vividly, this wildly, and this, exponentially is not very commonplace in the market. You can look at pink slips or you can look at penny stocks. I trade a lot of them myself. This is something that you want to be careful with and not having this part of your calculation for technical analysis. The reason why is if you're chasing such a monumental move, you're going to be disappointed in the market. You want to just try to get to first base or second base as much as you can. Stop trying to think that you're going to hit a grand slam for every trade that you're ever going to take. I promise you that that little nugget of wisdom will take you very far. So now let's go back here to the example. We always want to build context on the higher time frames. If you're trading or if you're a scalper, your higher time frame relative to you probably is the 30 or the 1 hour time frame. It's the same concept. If you're going to do this at a swing capacity, then use the daily and the weekly. If you're going to trade the 5-minute time frame, just make sure you're going out at least as high as the 30 or the 1 hour. What do we have here? Where are we identifying pockets of supply and demand? First of all, we have this area that consolidated. This is a new word that I'm introducing, but consolidation just means that price action didn't do anything for a little period. We call them boxes, right? In several trading books that you might read, those boxes are just building up energy for you to either break out or start breaking below. That's exactly what happened here. After a run, this was an earnings run, we went from 216 all the way up to approximately $350, and we hung out here for a little while. And then we saw an explosive move here to the upside. Why am I saying that Tesla is a difficult chart to trade? Well, we came back into this consolidating area. What is another word for consolidation? You can interpret this as a demand level. I would actually agree with that because you have several touches in this area. And remember what I said just a couple of minutes back, actually several minutes back. If you start breaking below a particular touch area, then you more than likely have stop losses set around here. Anyone that got in on Tesla between 325 all the way up to 350, you're probably setting a stop loss at 325 or maybe as low as $300 if you are so bold or so willing. If you start to trigger that, then we're going to have the situation that we saw on IWM. IWM was more of an event that you really couldn't punch out. You really had to predict the future in order for you to see this move that you saw to the downside. You want to be careful with this because 50% of the decisions you make will be technically based, right? You're going to look at the triple bottom, double bottom, whatever, but you also have to have an ear to the ground of what's happening in the market, what's happening geopolitically, what's happening on Twitter. Trading has become a lot more difficult than when it is I started. We used to use technical indicators and just go off that because we didn't have all this plethora of information at our fingertips, and the market is a lot more liquid. So things have changed since when I started. Let's go back here to Tesla. We've already identified that demand area, right? So let's go here to the 4-hour time frame. And that 4-hour time frame, we have, I would say, a nice little supply area, but now we're starting to really run into some of the concepts that we discussed in the IWM portion, where we're looking at lower highs overall. When we're looking at higher lows, it's generally 2 to 3 touches we want to look for. That combination is a deadly combination for you to rift off of a long position. Here we have the exact opposite of that. We came into a resistance level. No one is going to guess, at least not with any pinpoint accuracy. You can get lucky, and this is what I hate about the trading community. Sometimes someone calls the top and they say, okay, I made $25,000, $50,000, $100,000, and I'm the guy, but it's very difficult to repeat this. I'm not interested in the one-off. I'm not interested in the one lucky trade. I'm interested in getting to first, second, third base as consistently as I possibly can. That's where I'm coming from. So can you call that top? Do I generally call tops? Not really, but it does happen every once in a while. But take notice of that. That is that lower high. Why is that important? Because we're already losing momentum here. How can I prove that we're losing momentum? If I throw on an oscillator here or the volume bars, you can see that there's a little bit less volume overall with this second push. Now, how do I know that I'm going to follow suit with a short position that comes back down here? You have to build that context. Do I know that we were probably going to break down to this level and then see this level here very shortly? I actually did. I did call 330 back down on Tesla. I called this out a couple of weeks ago, but that's not the point. The point is that I identified the consolidating area, and then I said, this is the top of the consolidating area. It's about 350, and the lower part of that it was literally 330. So it's not about the level per se, but it's about the zone. This is a pretty significant zone. So let's do 350 because I called out 350. So that's about a 20-point zone. Cool. Now, if we start breaking even lower, the fact that I called this out correctly is not what I want you to take away from this. What I want you to take away from this is that I had the consolidating area to build my point of reference, my anchoring bias. Anchoring bias is it's huge in trading. So that is not only my anchoring bias, but obviously it was for whoever is trading Tesla. If we start breaking even lower and then start seeing some continuation here to the downside, this is going to be called an H pattern if we do see the continuation to the downside. Where do you think it is that I would want to take a trade on Tesla if we hit an area of interest? It's probably going to be back down here. Hopefully this is making sense because this is it. This is literally it. If we start breaking below $325 and then break all the way back down to $250, a lot of you are saying there is no way in hell that we are trading back down to those levels. Don't ever say that. That is the biggest mistake that you will ever make in trading, saying that something is impossible to happen. It was impossible for us on the daily time frame to see such a move from, actually, let's go even lower than that, from $180 all the way up to $400 in the span of 6-7 months. It was impossible. It happened. When we go back and see even more context on Tesla, it was impossible for some Tesla holders to see it at $415 and then seeing that trade back down to $115. I actually did call out Tesla at the time. I called it back down to $105 because I wanted to pick up shares at that point. So we never hit that, but I did take a long Tesla trade when I thought it was interesting enough. I took long Tesla here. I took it at approximately 125, and then I took Tesla long at approximately 185. So those were my two areas where I hit Tesla and I just waited for the pocket to happen. I know what y'all are thinking. On the weekly time frame, I'm not waiting for that. I want to be trading consistently. I want to be trading every day. That's okay. Take this principle and then apply it for any time frame, whatever time frame, right? Do you see area of interest or do you see any demand area? I don't see one. You have to go back further in time. If you don't see it off the 10-minute, look on the 30. Do you have that area? Well, I think you did. I think you did. You had one here at 330. See how things are starting to line up? And then you have one here at approximately $312. But Sage, you said don't do it off of a static level. You're absolutely right. You guys are really starting to get this. There it is. So you have those two zones, and those two zones is what it is you're going to wait for. Now, I talk about those touches in the previous section on IWM. Would I take that off the first touch? Probably not. Probably not. I'm going to look for a second strong touch, and that second touch is where I'm going to look to catch either the reversal. I wouldn't call this mean reverting because it's mean reverting here to the bottom. But on that second touch, I would wait for that bounce because I don't want to catch the dead cat bounce here. I want to wait for that second touch and then start filling some of the gap, at least back up to, let's say, $370. And I love whenever I'm teaching this stuff, everyone is saying, how do you know it's going to trade up to 370? You have no idea. That is not your responsibility. Your responsibility is to set good systematic trades repeatedly. And you do that over large quantities of trades. So if I'm setting a risk reward, think about that question. Keep that in the back of your head for a second. If I were to take that perfectly at the bottom, do you have a strong buy signal there? Some of you might argue, yeah. But I would argue I have no idea going back in time that that was going to be a point of interest. I know off of the 1 hour that 330 up to 350 would have been a good area, right? I'm not going to say it's not. But off that 30, how do I know that that is a buy signal? Some of you are going to take it off the first bounce. I don't recommend doing that. That's not part of my trading system. That's not what I'm trying to teach you. I'm trying to teach you off the second one. If you want to consider that the second bounce, that particular candle, that's okay. I would not disagree. I would actually say, hey, try your thing, but just make sure that stop loss is there. And then I'm going to take it up to a resistance point. So that resistance point already is yielding a 2.4 to 1, or I'm going to try to take it into that zone. That zone is going to take you approximately 367. So your risk reward is almost 3 to 1. Now, where this becomes not such a good trade is if this stop loss is moved back down here. It's already a 1.6 to 1. Some of you guys might be okay with a 1.6 to 1. That's okay. That's okay. I want to try to at least be clear and be very consistent with how I'm teaching this at adhering for a 2 to 1, right? The more you start moving this to the downside, the more you're screwing up your numbers and you're screwing up your data and you're literally shooting yourself in the foot. Don't be moving that stop loss down to this second or third demand level. That is a very bad idea. If you want to do something like this, take the trade off and then apply the trade once again, as we discussed on the IWM position. If you want to wait for this to trade back down to 312, 317, cool. Then you know that your risk reward is even better. What if that stock is trading lower, and you can't see a perceived bottom? That has everything to do with the efficient market hypothesis and actually picking good quality stocks and good quality ETFs. So that recovery aspect is something that you can rely on. Does everyone see why it is I picked Tesla and why this is difficult? Is Tesla 100% reliable? Do we know that this is not going to be gammeted off of a tweet? Do we know that someone is going to say something and then all of a sudden Tesla is in a lawsuit for this, lawsuit for that, and then we don't know. We have no idea. Your responsibility is identifying what it is we went over here. No indicators aside from just simple concepts that we are applying on the chart. Let's go back here to the daily time frame and let's see why it is I would wait on this trade. And I already showed you where I took this trade twice. I took it at 125 and then the other one was approximately 185. On the daily time frame, I see one gap back down here, and most of you are going to say that's good enough for me. It's not good for me. Not in my particular situation. I'm going to wait and I'm going to apply at least 2 to 3 demand levels. You do this on every chart, then you have more control over your psychology in the trade and also the trading decisions that you're going to make off of more information, well-rounded information at that. So let's go here. I'm going to say that that is an area of interest. Why would I say that? Because I think that there's a medium right here, and then this was a starting point for a jump. So we can maybe adjust that range up to about 250. I don't disagree with that. So between $210 to $250, that 40-point range, I would say that that would be an area of interest. If we start trading into this pocket, then I'm saying, okay, I think risk reward on Tesla is starting to become a little bit more favorable. Let's just check this out right here. I take that at exactly 330 and I set my stop loss. Let's just say 320. Let's be reasonable. 320, and then I'm going up to the previous resistance point. The risk reward is 6 to 1. It's not bad. It really, really is not bad. It's actually magnificent. Just imagine what the risk reward is if we're taking this at the top here. We start jumping, and then we're going up to at least where we started the consolidating box. It's now 8.5 to 1, so it's a little bit better. That's it. That literally is it right there. So that's the Tesla example. If we start breaking below $250, the lower we go, the better the risk reward. Let's do that exercise just once. Let's say we take an entry at 210. Sage, we're not trading at 210. Don't do that. Don't ever do that. Don't ever say that we're not going to go back down into a level, because that is a fool errand. 15 years of experience have taught me that if you say that something might not happen, it might not happen for the time period that maybe you're allotting, but you never know, ever know how low you can actually go. I'm pretty sure no one knew how low we were going to go for COVID and every other subsequent event that's happened on a global scale. You just don't know. Your responsibility is for you to wait on a setup that is so good that it is almost impossible for you not to fire on. Whatever trading system that you are using, that's how you need to look at trading. Remember, if you are doing anything else, then you have no consistency in your system, let alone what it is that you're trying to make money on, but just with your system and with your psychology in general. So take an entry back down here. You can take it to as high as you want, but I'm going to be realistic. Now my risk reward is 7.5 to 1. If I want to go even higher than that, if you want to take it to the peak because you do believe that Tesla falls under the efficient market hypothesis, then you have a banger of a trade. Cool. Let's look at my risk reward on Tesla for those two time frames that I gave you. The first time frame was here at 125. And then I took this off the first sign of resistance. So my first sign of resistance is right at that candle. I did not take this off above 200. I took it off at 192. So my risk reward is approximately 2.7 to 1. I took this with shares. I actually took this with leverage shares, so it was a little bit better than this. And then I took this at 185. So let's put that exactly where it is I took it. 185 here, and then I took it off at the first sign of resistance, which was approximately $242. So the risk reward was now 3.3 to 1. They're not staggering numbers, no, but this principle is applied in everything I do, and then it starts to compile. I mean, that's compounding in its most basic form. There's my analysis on Tesla for early 2025. If you do have a bias on Tesla, whether up or down, and you completely disagreed with everything that I said in the video, that's perfectly fine. We welcome that. And that's exactly why we have a market. Disagreements are rampant in the market. Thank God for that. I want you just to take notice of something. The common theme of you identifying supply and demand and then going off of specific triggers. I'm not here to tell you trade my trading system or buy my book. That's not the point of this. The point of this is for you to identify if you're going to use a trading system, use the same triggers every time, buy and sell, and then you go from there. There are other things that you're going to use in your calculation on whether you want to pull that trigger or not, and that is what we will explore going forward. Now, in the next example, just one more, I'm going to go over real world trades that I've taken in the last 2 years, made a little bit of money on, but that's not the point. The point is for you to see from the first and second examples where I identified the buy signals, where these are actual trades that I have taken myself in real time. Well, not in real time because these trades are now over with, but trades that I've actually identified why it is that I took them and how it is that you can apply what we are discussing, not with just the 3 stocks that we're going over, but on every other stock or ETF that you will take going forward. Remember, I don't care about what happened the last 6 months or who made how much money at what point in time. I don't care about that. I care about what's going to be happening in the future and trying to make an educated decision on where we are going next. So let's dive in. What you are looking at on your chart is the Dow Industrial Average represented as an ETF, also known as the diamonds. Now, this circle right here is the inception of my trading journey. I started in mid to late 2010. And now looking at this, I can't believe I remember this at $85. We're now at $445, which is mind-blowing to me. But this monthly time frame is not going to teach you how to trade. I want to give you more practical examples, as I said in the previous segment. On the weekly time frame, I used to really get pissed off with someone teaching trading and saying, I made a bunch of money at these points that now are very obvious that if I would have bought at that point, I would have also made a bunch of money. That to me is not something that is usable. What is usable is if I were to say what I identified at these points in order for me to pull the trigger. So I said this a few times, especially with Tesla. I don't know how high. I don't know how high the market is going to go, illustrated by very clearly on this monthly. Had I known, even at 18, 19, 20 years old, I would have taken all my parents' money and all my friends' money and just throw it into DIA, right? It would have been a ridiculous return here in 15 years. But off of the daily time frame, how do I know that I want to take these long positions? My most recent long on DIA was at $420. I actually took 2 trades at a massive scale because not only am I looking at this from a technical analysis standpoint, I understand the statistics behind the pullbacks that we have on the major indexes, or at least their ETFs. So I understand those numbers for DIA, for IWM, for QQQ, most definitely, and also for SPY. I understand that if we pull back 4 to 6%, then I understand how much money, or what is the buy the dip moment statistics there. And I also know that the further we start pulling back on those percentages, the more we start roaming into the 8, 10, 12, 14, 15% territory, that's when I really start getting greedy. So DIA is a perfect illustration of how I think about the market. Let's go here on the 1 hour time frame, which is the most recent. I am looking at this, and based on everything that we learned thus far, I won't spend too much time on this, but we'll go over this pretty quickly. We have a demand level at 418. I'm using something called the voodoo lines. We'll learn about the voodoo lines in different segments, not necessarily right now because there's a lot of information coming at you already at once. 418 is an area of interest for me because we've defended the area a few times, more than 3 to 4 times, right? Make a note of that. We came into this level, and what did I say previously? We don't know if we're going to start sweeping these lows. So instead of you being that person saying, hey, we're going to come into this area, and then we're definitely going to be bouncing off 418, and I'm going to be taking a massive trade because Sage said he took it at 418 last time. Nope. First demand level. And I just want to point that out. It's just the demand level that I'm going to pay attention. I'm more than likely going to set an alert, which I did at 420. Next, I'm going to go into the 4 hour time frame, and I already have that outlined, 420. Remember, I like to put on at least 2 to 4 demand levels. More than likely, you'll see me do 4. There's another one, and then here's going to be another one about there, and then I have another one at approximately here. So let's create zones in these places. One of the fundamental things that I recommend people do is never, ever say, hey, we can't pull back down that far. That is the biggest mistake that you can make from someone that's been doing this for a while. Don't do that. If you start trading back down to 420, then you got something to work with. I thought that I had that. I knew that at 420, I was probably going to take this again because I did that the first time here. And I also took this. I did not take this at 406. I took this at $395. As soon as I got my buy signal off of my system, then from there, the rest is history. I just wrote it. I like looking at the DIA chart because I know very well, based off historical data, it trends so nicely. This is, for me, it's kind of like looking at, I can't even say, I don't even want to say in this video, but it is just beautiful looking at this chart. I want you to identify that in every chart that you take, whether you're trading Costco, SPY, QQQ. QQQ is even better. Some of you are going to say, hey, the return on Qs were even better. That's if you're buying shares. Cool. If you're trading like we are, and if you're taking calls or if you're taking some sort of shares position, fine. It's the same thing. Don't change. I've been trading QQQ long for about 1.5 years since the making of this video. It's not going to change. But let's go back here to DIA because I don't have to take QQQ or DIA. Sometimes I do both. I came back into this demand level. That was 2 touches. What did I say about my trading system? I like 2 to 3 touches, and then from there, I take it. If we start breaking even lower, I'm going to designate the 405 area. But how do I know that we're not going to be bouncing off of 411, 412, 413? I don't know. I have no clue. No clue whatsoever. It's all about and if statements. If you're a programmer, if you're a coder, you understand what that is. Your and if statements are going to be, as we come, I can deduce from my conclusion that the more we pull back, the better the risk reward is going to be. It always comes back down to this. Some of you guys complicate this way too much, and I don't understand why. I don't know where you guys have been getting some information. This is it right here. You come back down and you fill that gap all the way down there. You set your stop loss. My risk reward is already 8 to 1. Do you see why I love DIA so much? I freaking love this ticker. I love this ETF. A little bit lower, then I'm looking at, because I know it's going to go to an all-time high level. I just don't know the time frame. I have no idea. Right? Common novice question is, how do you know when we're going to hit all-time highs? I have no clue. Absolutely no clue. I just know that it will eventually happen. So now what's my risk reward if we got back down to like 405 or 408? It's 12 to 1. Do you not think that I'm going to be putting a little bit of volume behind that? Do you not think that maybe I'll up the risk on that? Well, be careful. Be careful. Just because I'm doing that and I'm saying that in this video does not give you the license to do that if you don't have the experience that you need to bring to the table. The more you pull back, the more of a pullback that you see on any of the ETFs, that's where I make my generational wealth. Those are the setups that I'm generally waiting for. That's why I say that you should constantly be waiting for your setup as a trader. How are we going to apply this on some of the shorter time frames? It's the same thing. I have a demand level, or I would call this a support demand level right back down here. This is where most of you get this kind of trippy. Most of you are going to say, okay, I think we're going to see a push up there to the upside. I don't disagree. I really, really don't disagree. I'm going to say, okay, if you do see that push, how far can you go from there? Well, Sage, if you're looking at that daily time frame, you have this elongated period where you keep on overextending, and it looks like the stock will be going up forever. I don't disagree with that. I would just prefer to have better risk reward if I'm going to do something like that. Back onto the 1 hour, we're going to identify that support. If we come back down to here, what is the better risk reward? Is it to the upside or to the downside? So I'm now really going to make you think. If most of you are intuitively saying, hey, it's going to be to the downside, then you are starting to get this. If I put an upside trade and I set the stop loss there, this is a fine trade. It really, really is okay. As long as you set that stop loss there, you have a 5 to 1 risk reward. Beautiful. I will not critique that whatsoever. What is the better risk reward if you have your entry at $441.25 and then you're saying, hey, I can probably take that down to about there. Now the risk reward becomes almost 3 times, if not 2 to 3 times better if you can ride a trade back down here. You don't know if you're going to get back down to 425. You have no clue. Absolutely no clue. So be reasonable with your price targets. What we are recommending, and what I would recommend till my deathbed, is at least 2 to 1. Okay? 2 to 1. If you guys haven't already come to this conclusion, you don't need an astronomically high win rate in order for you to be successful with 2 to 1. You need to be right approximately 35 to 37% of the time. That's why we recommend 2 to 1. If you do anything better than 2 to 1, if you do a 3 to 1, right? If you strictly adhere to a 3 to 1 risk reward profile, then you don't even have to be right more than, let's say, 30% of the time. Imagine saying to someone, you don't have to be right 70% of the time and you can still make money. Well, in some of the books that I like to read, this one in particular, this one is a fairly newer book. A lot of the people in this book, they don't really have a win rate above 30, 35%, and they are managing some of the biggest accounts, billions of dollars collectively between them. It's all about this. They understand this concept so well. It is part of every fiber of their being. No exaggeration when it comes to that at all. So how do I know that I'm going to fire on a short? Well, if your signal or your oscillator or maybe your moving average or your system or your order block or your TTM or whatever is telling you, hey, we can break that shelf, which is a new terminology that I'm introducing here. If that is the case, pull the trigger. I probably wouldn't do it with that much size, but I will pull the trigger and just set the stop loss accordingly, 5, 10%, and you keep it at that. All right. Now let's do a deliberate, 100% deliberate analysis on this where I put some money behind this and a little bit of money was made for sure. I'm going to set my demand level at approximately there, and that's no fluff. I'm not guessing that level. That level is an anchoring bias off of 417 all the way up to 419. I try to use the voodoo lines, which is support and resistance, which is a premium indicator to try to identify supply and demand levels more to my advantage. We'll discuss more about that in a different video. I have another one here, and then I also have another one here. So that's already 3 demand levels. Guess what I'm going to do when it comes back down to there? If I start seeing a buy signal firing, probably going to take it. What are my buy signals? This is where it starts to get interesting. Off of the daily time frame, most of you should be taught that your 200-day moving average is an incredibly important injunction point for your indexes. If you did not know that, then I'm opening up a can of worms when it comes to this. The 200-day moving average for any significant stock in the market is a critical injunction point. That is where the institutions are deciding whether they want to be building a position or building position for long term on any particular stock. On the ETFs, what do you think that means? The ETFs drive the market. The ETFs are going to be an output of what's going on the singular stocks. If you know what the top holdings are for the DIA, for SPY, for QQQ, for IWM, and you know that those stocks are doing well, or they're trending, or they're playing off momentum, and they're at these significant moving averages, what do you think is going to happen off of the indexes, right? I'm inferring a whole heck of a lot right here. But if you don't know these fundamental things, right? Pillar number one, understanding the environment. If you do not know those fundamental things, then you are at a disadvantage against people like me, because I know those things. You better know those things as well. So daily time frame, we didn't necessarily come into the 200 moving average. Let's check out the 4 hour. We were almost there, but that 4 hour time frame for me confirmed a buy signal, not because I'm looking back in time and saying, obviously it was there. I've been incredibly consistent when it comes to what the buy signal needs to be and how to read it. That's the buy signal there. It literally is. And that's where I took my trade. You will learn how to use the moving averages, why I use the moving averages, and why I use the TTM and the volume bars when we do another very, very long video, right? Because this video is already coming up on almost an hour, I believe. You will learn to identify, boom, I take that trade and then I set my risk reward calculator, and then the rest is basically history. The more you do this, the more muscle memory, the more confidence you can have on the decisions that you can make, right? So some of you will say, hey, I'll put $100 behind that. I put 6 figures behind this trade. No cap, okay? I did that on this. I did that on Apple for this time period that we're in, and several other trades that I don't need to disclose here, but I put a lot of money behind this trade. I put it there because if I did take a loss, if I took, let's just say $100,000 I put on this and I took a 10% loss, I'm taking a $10,000 loss. Fine. I'll do a $10,000 loss here, and then I'll look to make it back on a better risk reward trade that I'll do somewhere down the road. If I'm not identifying that correctly, just because I lost on the trade doesn't mean that the trade was a bad trade. Some of you get this twisted and you conflate this. Just because you took a 5-10% loss does not mean you're a crappy trader. If you took this and then you held for a 60% gap lower and you're not doing anything else to defend it, then that's a crappy mistake. Then you're actually trading like a novice. There are so many things that you can do to defend the trade. You can do it with options. We can get into that in later videos. But if you are going to take a trade here, you take a $10,000 loss because you put in $100,000. It's a 10% drawdown, and then you jump back into the trade later on, and then you start seeing that movement there to the upside, then now you're focusing on the right things. Cool? That is what the entire premise is of you knowing what your touch points are, what your higher lows, higher highs are, and what your supply and demand levels are. So in the videos that we've talked about, right, in the subsequent segments that we have discussed thus far, all it is, your responsibility is seeing where the ceiling can be, seeing where the perceived bottom or the perceived floor can be, perceived, because don't take it as absolution. You see it as a perceived level, and then from there, you have a couple of other parameters, right? Hopefully I did a good job in explaining this. You have a couple of other things that you are designating as maybe trigger points for you to say, okay, now I have 3, maybe 4, or maybe even 5 things if you want to be extremely, extremely thorough, which I generally don't recommend, but about 3 things saying, hey, maybe we can try something here where the probability is in my court as opposed to market maker's court, which we don't want market makers to be at an advantage. Cool. That's the DIA trade. I have taken it at those increments that I showed you on those 4-hour time frames. The only exception is that I did not take this at $405. Whenever I see that and I definitely took this here. Whenever we see certain setups like this, especially on the ETFs, I'm telling you now, based on the 4 ETFs, whenever you see a setup like this, it should excite you. It definitely excites me. I've been doing this for 15 years. It's something that if you learn how to identify at its most basic form, and this is just basic stuff, this can make you extremely, extremely profitable. We went over so much information in just 3 examples with very, very fundamental concepts. Now, going forward, we're going to start building upon our trading system with additional indicators that we use to trigger that buy or that sell signal. Remember, all the foundational concepts are going to always be interwoven into the general idea of what trading is all about. what we did, I mean, pretty consistently, is identifying if we are going to take a trade, what is the risk reward? Does it favor the long or does it favor the short? That is the question that you need to be asking yourself. My recommendation, being on the other side of this, I remember when I was first looking at YouTube videos and trying to find exactly someone that I can emulate, I would take some of these examples and make sure that I'm doing this on as many charts as I possibly can. Don't just do it on 3 or 4 or 5 charts. I've been doing this for every single day, pretty close to 14 years. So this is very intuitive to me, just like speaking the English or the Portuguese language. It's just something that naturally is part of my thought process. You want to make this as intuitive as that. Is it a lot of work? Yes, it is a lot of work, but making easy money doesn't come so easy. So think about that. I want to leave you with this. Bruce Lee, I think, has said it best, and it's so applicable here. Do not be the person that's practicing 10,000 kicks just once. Be the person that practices one kick 10,000 times. See you guys in the next video.